Okay, so good morning. So last week, we started with IFRS 2 on share-based payments. So this week, which is week 4, we are supposed to start with IAS 19 on employee benefits, if you look at our plan. But we have not done with this, so we need to properly finish up IFRS 2. Then we proceed to IAS 19. So last week, we established that the way transactions are commonly consummated is that entities would pay cash or certain consideration for goods or services they have received. That's how transactions are commonly consummated. However, in recent time, these have changed because now entities are now ready to give out their shares or share option for goods or services they have received. And we look at the 3 ways in which this can occur. One way is one that is clear, where they give their shares or their share option in return for goods or services that they have what? Received. Another way is where they are ready to still give cash, but the amount of cash will depend on their share price. They attach it to their what? Share price. And the third one is where there is a choice of settlement, in the sense that the buyer gives the seller a choice between either accepting shares or share options for those goods or accepting cash based on the value of the shares of the buyer. Those are the 3 ways in which this can happen. So last week we started with equity settled. Today we're going to finish it up. And we're going to end this class with deferred tax implication of share-based payments. So we'll look at all of that. Now, for equity settled, we explained majorly that what you need to understand very well is that these shares, when it comes to shares, that we might not necessarily find that in the exam because it assumes that, in fact, it's only applicable where the supplier has offered the service. So the service has already been offered. That is the only situation where the buyer will give you its shares. Because when they give you its shares, you already have it. So we don't expect anything from you again. So we immediately said we should not look at that side because it might not happen as a standalone question. It could be part of an additional information that, okay, they got service and in return they gave out their shares, not a standalone question. The one that can come in as a standalone question is where what the buyer is ready to give as consideration is its share option. And share option, I told you last week, is an agreement where the buyer says that I'm giving you this opportunity to buy my shares at a specified future price at a specified date. That specified future price, we said that price is an exercise price. That specified future date, we said that date is a vesting date. Before that period, the buyer would expect the supplier, or we narrowed it down to the employee to render certain service over that period. We said that period in which they have to render that service, we said is the vesting period. And those services, we said they are vesting conditions, right? And we focused our attention majorly on the non-market condition. And the non-market condition is where the condition has to do with service period. Work with us for 3 years. Ensure you achieve a profit target. Those are non-market conditions. Though there are market conditions too, where they will tell the supplier or the employee that before you can get this share option or before it can vest, our share price must move from this stage to the next stage, meaning that increase our share price. Okay? So the fundamental thing there is this. Because share option will ultimately go to an employee or a supplier that has met the condition or that is there till the vesting date. Because of that, we need to find a way to account for these share-based payments over the vesting period. Over the what? Vesting period. And at each reporting date for equity settled share-based payments, you need to estimate the number of employees that will be in employment till the vesting date. Alternatively, the number of employees that will eventually vest or that will meet the vesting condition. That estimate has to be made at each reporting year end so that at that date, we already know the number of people that are what? That are vesting. And that was the main technical thing we had there that took our time for you guys to understand. And I gave you assignments, which majorly is just for you to look at these things again, so that before you come here today, your knowledge will have been advanced. Now, another thing that was also important beyond the number of employees that will vest at the vesting date is also how do you value this share option at each reporting date. We said that you value this share option at the fair value of the share option at when? The grant date. The grant date. And we emphasize that do not, because the examiner will give you a lot of share fair value. They will give you fair value at each year end. They will give you the share price of the company. We don't need all of that. The only thing we need is the fair value of the share option at when? Grant date. And the grant date is the date the contract was executed or the date of the agreement. That is the grant date. We solved some questions last week. Now, before I proceed today on equity settled share-based payments, let's solve the solution to the assignment I gave to you. So let's open our assignments. Let somebody read the first question. Okay, so this is 11. We have approximately like 2.5 hours. Let's make it worthwhile. We'll stop the class by 1:30. So who is reading? You want to read? Who wants to read? Yes. Okay, this is you are the one that reads in my class. Oh yeah, let me give her. Yes, the first question. I sent 3 questions. I sent, no, it's not in the pack. It's not in the pack. I sent it to the group. It's not in the pack. I sent it to the group. I sent it to the group. Last week, someone there. Are you for real? Some of you didn't even open it at all.
Yeah.
Are you all there?
No. Question 1. A company grants.
Are you all there? Yeah. Okay, I think we're all there. Yeah, let's read.
Question 1. A company grants 2,000 share options to each of its 3 directors on 1st January 20x6, subject to the directors being employed on 31st December 20x8. The options vest on 31st December 20x8. The fair value of each option on 1st January 20x6 is 10 naira, and it is anticipated that on 1st January 20x6, all of the share options will vest on 31st December 20x8. The options will only vest if the company's share price reaches 14 naira per share. The share price at 31st December 20x6 is 8 naira, and it is not anticipated that it will rise over the next 2 years. It is anticipated that on 31st December 20x6, only 2 directors will be employed on 31st December 20x8. How will the share options be treated in the financial statements for the year ended 31st December 20x6?
Okay. Now, one skills we must develop is your ability to understand the requirements of the question. You need to understand it very well. If you look at what this question is asking us to do, is that we should prepare an extract of financial statement. Abi? For the year ended when?
31st December 20x.
Exactly. 34th December 20x. The mistake I saw people that submitted did is that they did for all the periods and you didn't even prepare a financial statement extract. Right? So that will not give you so much marks in the exam. You need to do exactly what the examiner has asked you to do. If he's asked you for a financial statement extract, do an extract. Don't do something else, right? Okay, so how do we achieve that? Before we can do an extract, we need to do some workings, right? And from the question, you will see that what was granted is a share option. And so we're looking at 2006. What is important is the number of directors that will what? That will vest. When is the vesting date? 20x8. That means the vesting period is how many years? 6, 7, 8. Abi? Okay. What assumption did they give us in 2006?
It is anticipated that on 1st January 20x6, all the directors will vest on 31st December 20x18. For the share price,
So how many directors will vest at 31st December 2008? Did they tell us that in the question?
yes.
Okay, in the last sentence of that question, that it is anticipated that only 2 directors would remain till Abi. Okay, so I think this one is straightforward. So it's just 2. They gave us directly. So now, since we have gotten that, so let's get the fair value of this share option. Since we know the number of directors is 2, Abi, how many options are we giving to each of them? 2,000 option. Now, it is valued at the fair value of the share option at the grant date. How much is that? At the grant date. And the grant date is when? Okay, so how much is this? How much? Okay, so look up. So based on the fair value of this, like the fair value of that share option itself. This is the total value of the share option we think that we will give. This is the value of that option that we think we want to give to the people that will vest. This is the value of everything. Now, what goes to, let me do my cumulative balance. So in year one is going to be 40,000 multiplied by 1 over what? 3. And this is how much? 13,000. And what goes to our P&L? Is 13,000. Please ask.
Fair value of share option. The excise price minus the share price will not give you 10 naira.
The exercise price minus. Yeah. So we told you that that's how it's computed. But most of the time, if it's not the same, it means that the share price will likely change. That is not every time it will be the same. So the intrinsic value is the share price minus the exercise price. And that intrinsic value is what guides us in determining the fair value of the share option. Okay? If they are not the same, because they might not be the same. If they are not the same, so that means ultimately it will become the same, maybe at the vesting date. But that's the guide.
When I was attempting this question, one of the conditions was that the price must be 14 naira. So
Okay,
that's
okay,
why
okay,
I did
okay.
not use the fair value of the grant date directly. I knew that was I didn't use it since the one of the conditions was
Not met.
Yes. So I had to now
Okay, okay,
do
okay.
some calculation.
Okay, okay. I think that's a good question. Now I understand that question. Okay, you want to ask? Sorry, I didn't hear you. Okay, the what's that 8 naira? Don't use the share price. Don't use the share price. You have to use the fair value of the share option at the grant date. Okay, now back to you. So she said that in this case, they didn't only give them non-market condition, which is service period. They also give them market condition, which is that the share price must go up. Okay, so see, for IFRS 2 says that in determining what you book, the double entries, don't consider the market condition does not affect the double entry, right? Because in the calculation of the fair value of the share option, in valuing that share fair value of share option, that this 10 error, one of the variables used is that market condition. They will have considered it in determining it. Okay? So it won't affect, just ignore it. Just ignore it. Okay, so now this is our workings. But what did they ask us to do? Statement of profit or loss, Abi, for the year ended when 20. Okay. Yeah, I get what you're saying. I think it actually makes sense. So, you know that what we are just accounting for, we are accounting for the existence of that transaction. We are accounting for the fact that it exists. Okay? You know, we have not actually talked about the exercise, right? So maybe at the exercise date now, okay, it's now left to them to say, ah, Shibi, you did not meet the
And they giving us the estimate on Canberra that says that at that date we will not reach that 14 million.
and the standard I've told you that for your book, for your double entry, you don't consider it. Okay, so the effect of that will be when they want to exercise it, then they will start looking at whatever condition. But for the double entry, it doesn't affect it because they will have considered it in determining this one. Okay, so this is 13,333, and in my statement of financial position, under equity, what do we have? Which is how much? 13,333. Okay. Yeah, let's read the second question. Wait to. Let me give it to her. Yeah, second question.
Question 3.
Okay.
A company grants 750 share options to each of its 6 directors on 1st May 20x7. The options vest on 30th April 20x9. The fair value of each option on 1st May 20x7 is 15 naira and 10 naira per share on 30th April 20x8. It is anticipated that all of the share options will vest on 30 April 20x9. what will be the accounting entry in the financial statements for the year ended 30 April 20x8?
Okay, you see that for this question, the requirement is different. The requirement is what is the accounting entry? They didn't ask us to prepare a statement extract. So what they want us to do is debit and credit. And you have to do that for them. But before we do that, we need to start with our workings. For what is the relevant year here? Which year are we looking at? 2008. Okay, so for this 2008 now, how many directors will vest at the vesting date from here? How did you know? How did you know? Okay, show me, Mr. Odum.
I stated that all the shares options will first and that 30%.
At the end of
Okay, that's correct. So that means in 2008, Abi, it's going to be, what's the number of directors? 6. Abi? So if this is 6, so how many share options are we looking at? 750. So how much is this one is 15 naira at the grand date? At the grand date. Okay, so how much is this? 37,000? 67,500. Okay, so what's the vesting period? Okay, when will it vest? When is it supposed to vest? 2009, 28, 29. That's not 3 years now. That's 2 years. And is it 3 or 2? Okay, it started from 7. Let me see, show me.
first, the grand date is 1st of May 20x7.
Okay, if it started from May, so that means the first one will end in 28, then 29. It's 2 years, so it's not 3 years. So that is 67,500 multiplied by what? 1/2. So what will be in our remuneration expense? How much? 33,750. So what will be the accounting entry? What will you debit? You debit remuneration expense, Abi? With how much? What do you credit? Option what? With how much? Okay, so this will have given us a mark. So again, you have to learn at this level to do what the examiner has asked you to do. You start with your workings. When you do your workings, do the accounting entry they asked you to do. If it's financial statement extract, do the financial statement extract. Hey, Sadiq. Please. You should try and be doing your assignments. You should try and be doing your assignments. You want to ask a question? Was? The grant date. Yes. Yes. That's why we use 15 now. Okay. Let's read the third question. Ledger.
Question 5. Debtor prepares financial statements to 31st December each year. On 1st January 2023, Beta granted share options to 50 senior executives. Each executive was granted 1,000 options. The options will vest on 31st December 20x5, provided the executives remain employed by Beta throughout the 3-year period from 1st January 20x3 to 31st December 20x5. The options are exercisable, that is, the shares can be purchased at any time from 30 June 20x6 to 31st December 20x7. Under the terms of the agreement, the
Okay. Okay. They mentioned throughout the 3 years period. And I'm sure now. Okay, yeah, that's true. Okay, the question did not specify really because if you look at the requirement, they said just calculate the amount to be recognized. But I mean, you just have to do for the periods, for the 3 periods. Okay, when is the grant date? 4th January 2003, Abi? When is the vesting date? 2005. So what's the vesting period? It's 3 years. How did you 20x 3, 20x 4, 20x 5? Abi? So it's 3 years. Please ask.
It still said that the options are exercisable at